Okay, so good evening and a very warm welcome to all the participants joining us for today's webinar on strategic allocation to AIF, enhancing portfolio diversification and long-term wealth creation. A very interesting topic indeed. We are truly honored to have with us a distinguished expert, Mr. Aditya Jadhav, as our speaker for the session. Mr. Jadhav, a CFA chartered holder, brings over 12 years of rich experience in investment domain, having created substantial value in venture capital and private equity. He has a proven track record of managing VC funds at Sydney, where he played a pivotal role in investment across agri-tech, food tech, fintech sectors, delivering remarkable returns. He is the founder of Ganbaru Capital, which advises HNIs and investors on public and private market investment. Beyond investment, Mr. Jadhav has also been instrumental in facilitating strategic exits for startups and leading fundraising initiatives. An engineer from VJTI with an MBA in finance, his expertise is complemented by his passion for mentoring student-led startups and supporting technology incubators, further showcasing his commitment to fostering innovation and growth. It is my privilege to have you here with us today, sir. And without further delay, I would now invite you to take the stage and share your valuable insights with us.
Good evening, everyone, and welcome to the webinar. I know these days now lot of people have curious or interest in investing into AI, or they want to invest into private market. Lot of people have started investing into big unicorns like Swiggy, maybe even NSE, or a lot of other good investment opportunities which are likely to come up with an IPO. Of course, the objective of such kind of private investment is to generate more wealth and higher return. But rather than taking into untraditional route of investing into such kind of private investment, if you want to make it a regular practice and enhance your route or enhance your return, the ideal way to generate such kind of good return is by allocating your capital to AI. Now, before we actually start understanding how we can allocate the capital to AI to generate higher return, let's first understand what is AI. So let's understand the AI industry. If we look at the AI industry, it was earlier called a VC industry or VCF industry. The regulation regarding AI, or known as an alternative investment fund, was the start of a VC capital fund regulation started by SEBI in 1996. If you look at the history of AI, in 1996, SEBI launched the VC capital or venture capital fund regulation, and at that time, we are talking about before the Y2K boom, there were only three venture capital existing in India. One of them was Sidbi Venture Capital, my alma mater. Then second was GVFL, that's a Gujarat Venture Fund Limited, and third was the ICICI Venture. So these were there were the only three VC fund existing at that time in India. That's why most of the capital that were getting invested in Indian startup ecosystem or ventures, right, were majorly a foreign capital. That's why SEBI came out with a foreign venture capital regulation in 2000, wherein it was necessary that all VC funds which are operating in India or investing in India have to register themselves with SEBI VC capital or venture capital regulation and to comply with those kind of regulation. But post 2000 or 2003, we as a startup ecosystem started developing exponentially. To give you a number, we have more than 1 lakh startup in India, and we are the third largest startup ecosystem in the world. Of course, first being US and Israel, we are the third largest, and we do attract a lot of venture capital investment from across the globe. That's why SEBI decided to revamp its foreign venture capital regulation and started with AIF regulation in 2012. AIF stand for Alternative Investment Fund. It's a kind of special purpose vehicle created by venture capital funds or venture capital investment manager so that they can raise all commitments or capital in that AIF vehicle or SPV, and the same vehicle or SPV can be utilized to make an investment into various startups. So consider that AIF as a portfolio of a startup investment. So in 2012 onwards, all VC funds which are operating in India or rather raising capital in domestic market are needs to be registered with AIF regulation of a SEBI. So as described earlier, AIF is a privately pooled investment vehicle, and one of the primary criteria or the major criteria of contributing to this AIF that you have to make a investment worth of at least 1 crore in the AIF, which means that this is a vehicle targeted towards majorly HNI or ultra HNI who can at least contribute 1 CR in this vehicle alone. Generally, AIF can be categorized into three broad categories. Category one, that has been described as a Cat 1 AIF. Another is Category 2, which is a Cat 2 AIF, and third one is a Cat 3 AIF. So let's understand what is a Cat 1 AIF. So Cat 1 AIF is a typically a venture capital AIF, which is primarily created for investment into startup, early stage ventures, or maybe SMEs, then social impact investments, right? So these are all Category 1 VC funds, a traditional VC fund. Now let's, before we understand what is category 2, let's understand first what is category 3 AIF. So cat 3 AIF is majorly comprises of a hedge fund or maybe a private I would say that a AIF which invests into public market like a listed stocks. So cat 3 AIF generally use complex trading strategies of long short or maybe a hedge fund type of, right, and they are allowed to leverage themselves by borrowing from other source of capital. So these are the two broad categories of typical VC fund or investment into startup, and third category is a hedge fund or a I would say that private investment into public market or called pipe funds. And the category 2 funds are known as a funds or strategies which does not belong to either cat 1 category or a cat 3 category. So which means that anyone which does not either fit into cat 1 category or cat 3 category will be considered as a cat 2 category. But one of the criteria that they have to follow or abide is that they are not allowed to engage themselves into leverage or borrowing like a cat 3 fund. So now that we know the overview of AIF industry with three subcategory, let's understand how the AIF industry has evolved starting from 1996 to 2024. If I look at the AIF, right, they have recently gained the popularity. Of course, the biggest credit goes to the evolving startup ecosystem, which is generating lot of interest from young generation and investors. So second category or second biggest reason is robust growth of domestic investment manager. As I said, before 2002 or 2000, there were only three domestic VC funds: SIDBI Venture Capital, GVFL, and ICICI Venture. But post 2003, now we have more than 1200 investment managers, which means we have more than 1200 VC funds. A large portion of them have been a domestic VC firm. I can count a lot of them. It's a K Capital, India Quotient, Bloom. It's a long list of domestic investment manager, and these all have been created in the last 2 decades. So we have given up as a, I would say that as a startup ecosystem, we have created this huge list of investment manager. Not just about the growth of investment manager, these investments managers have raised a large amount of commitment either from domestic investors or from a global LPs like a big institutions or pension funds. So these are the two major reasons because of which the AIF industry has grown exponentially in the last 2 decades. So these are the kind of numbers that are mind boggling if I look at the number of investment manager. And category 2 is a flag bearer because in the last 5 years it has grown exponentially. I would say that two-thirds of its growth has taken place in the last 5 years. If I look at the total number of investment managers as on March 24, the number of managers are more than 1200. To be precise, it's a 1283, and almost 60-65% of them have been created in the last 5 years. Okay, and that the number speaks for themselves. 80% of these AIF, as the number says, belongs to Cat 2 category AIFs. And if I look at the breakup of this Cat 1 and Cat 3 AIF or Cat 2 AIF, right? A 60% of them are a first time investment managers, and this is their first fund. 22% of these investments manager have already launched the fund, and this is their second fund. And of course, almost only 18% or one fifth of these investment managers have experience of launching more than two funds. So I would say that in a nutshell, we have a young breed of investment manager. They have launched the fund for the first time and raised a huge amount of investment or commitments from their LPs. Now, this is the higher commitment which has been raised by this investment. And if you look at the growth, almost the commitments in the last 5 years has grown by 5x, and large portion of that has come from category 2 AIF, which has grown by 4.5 times in the last 5 years. So definitely the credit goes to Cat 2 AI, which has grown exponentially, leading to this growth of the AIF industry. And if I look at as on today, on March 24, the total commitment raised by the complete AIF industry is 4.5 trillion, which means it's a 4.5 lakh crore commitment raised by the domestic AIF industry. And almost 80 or almost 90, 85 to 90% of that commitment has been already deployed in the startups or other category of investment funds. So now let's move on to their list of LPs or the source of the capital. Maybe it becomes a kind of notion that large money from foreign investor would have contributed to this surge in a commitments, but not. To break that myth, if I look at the contributors, a large portion of that contribution has come from a domestic, and the domestic investors participation has increased by almost 10x in the last 8 to 9 years. So that has been the surge of a domestic investors contribution. If I look at the category 1 AIF, which is a typical VC investment, almost 70% of the contribution has come from a domestic HNI and ultra HNI. If I look at the category 2, which is the biggest contributor to the towards the growth of a AIF industry, almost 49%, which is a like 50-50 ratio, has come from a domestic investor. It could be institutional investors like CDB, LIC, or family offices, or it could be an individual HNI or ultra HNI. But that domestic money has contributed a lot to the growth of a AF industry. Wherein, if I look at the Cat 3, which is a more of a pipe or hedge fund industry, almost more than 90% contribution has come from a domestic investors. So this, in nutshell, tell you that okay, this complete surge in the AF industry has been led by the participation of a domestic investors and not because of the participation of any foreign investors. Now look at or understand what would be the role of AIF in your portfolio if you are actively involved or actively invested into domestic capital market. To understand that, before let's understand what is alternatives. As the name suggests, Alternatives is a category of a investment or category of asset class other than traditional asset class like a commodity, gold or base metals, or equity or a bond. That's why any other asset class does not fall into this kind of category is called alternative. And these alternative as an asset class can be further subclassified into three other type of asset classes. One is a alpha seeking, wherein the objective is to generate more or higher return, and such kind of investor do invest into private equity or distressed credit or hedge funds so that they can generate a more return compared to public market. The second subset of our alternative investments is a income generating, wherein the main objective is not to generate a higher return, but to generate a regular source of a income or a capital. That's why investment manager invest into alternative assets such as real estate, which gives you a monthly cash flow, or maybe a private credit which gives you a coupon on a regular basis, or other asset classes like transportation or timber which gives you a regular cash flow of a capital. And third one is a diversification. So this is the kind of category of alternative wherein the main objective is not to generate a higher income, but to diversify your portfolio and reduce the risk from equity and the bond. And these are the kind of asset classes which falls under diversification alternatives. But first of all, let's understand why should we add alternative in our investment portfolio. The first objective would be a diversification, because that's the main objective of adding alternative as an asset class to your portfolio. But how do you diversify? So if I look at the diversification index, which is measured in correlation, basically correlation measures the relationship between two asset classes. So suppose if I look at a investment in a Reliance stock compared to asset class like a index Nifty, then I would say that the correlation between Reliance and a Nifty 50 would be closer to 1. As Reliance goes up, so the Nifty would go up. So their relationship would closely related to each other. Vis-a-vis inverse relation, which is depicted by the -1. So inverse relation can be observed in asset class such as USD and a gold. If gold rises, then probably that's because of the fall of or depreciation of a USD. Since both of them have an inverse relationship, it can be combined together as a part of a one asset folio. So if you look at this complete chart, this gives you the description of a various asset class and the benefits provided by this alternative. If I look at the private equity as an asset class, it generates a higher return, or it increases or reduces the portfolio volatility significantly, but it's lower in terms of income stream. So if person is looking to add a regular source of income, then ideally they should invest into private debt or a real estate which can offer them a reliable or regular income source. If someone is looking to hedge the inflation or protect the portfolio from inflation, then ideally he should invest into alternatives such as real estate. So this is the kind of a correlation exists vis-a-vis other asset classes such as equity. And that's why if you are looking for a to reduce the risk by diversifying your equity portfolio or bond portfolio, you have to add a alternative investment as an asset class. Now, what could be the second objective apart from diversifying your risk or diversifying your portfolio? As I said, that enhancing return as an ultra HNI or HNI, I might not be satisfied with a public market return. I might want to take a higher risk because of my higher risk appetite. Then I can look for that enhancing return by investing into alternative assets, which offers me that kind of risk vis-a-vis return. But end of the day, that decision has to be taken by aligning your needs vis-a-vis the benefits offered by that alternative asset class. So now take an example that allocating to alternative can enhance the risk adjustment return of that HNI and ultra HNI. Now look at this traditional portfolio of 80% equity and 20% bond. So this portfolio offers me around return of a 9.5%, but offers me the volatility or standard deviation of a 13%. But if I shift it from an asset class wherein I have only exposure to 50% equity, 20% bond, and 30% to alternative investments, which means that additional 30% from equity have been allocated to alternative investment. By virtue of that, I might have got a small incremental benefit of higher return, but I have reduced the standard deviation or risk almost by more than 3.5%, and now the standard deviation is less than 10%. Similarly, if I look at another portfolio wherein I have a 60% equity and 40% bond, I can diversify that into 40% equity, 30% bonds, and 30% alternatives. By doing this, I have not only enhanced my return from 8.5 to 9%, but I also reduce my risk from 10% to 8%. So that's a significant benefit. And this kind of enhancement of return with a reduced volatility increases my performance or Sharpe ratio significantly. Similarly, if I look at a third portfolio, which is heavily skewed towards income generating bonds, with a 60% portfolio of a bond, 40% investment into equity, this can be diversified into 40% bond. So we have diversified or transferred the 20% bond allocation to alternative and reduce that 40% allocation to equity to 30%. So totally in nutshell, we have a 30% allocation to alternative investment. And by virtue of this, I have significantly increased my return from 7.5 to 8.5% and reduce my volatility, right? So these are the kind of benefit offered by investment into alternative investment. You not only increases the return, but you also reduce the risk significantly, increasing your Sharpe ratio. But of course, when we compare the performance of VCP market are always compared with the public market, which are very easier for any normal retail investor or HNI to invest into. If I look at the performance of a private vis-a-vis public market, generally or majority of the time, private funds like alternative or VCP have outperformed the public market over the longer period of time. But first of all, we have to understand the profile of a cash flow offered by VC or P. If you look at the normal tenure of a 8 to 10 year of a VC or P, initial 5 years there will not be any kind of cash income generated. But initial 5 years only drawdown will happen, and the investor have to invest depending upon the drawdown requirement of an investment manager. But over the next 3 years, as investment matures and generate substantial wealth, it performs or outperforms the other public market. So if we have to understand or compare the performance of a private fund like a VCP vis-a-vis public market fund, we have to first mimic the investment strategy of a VC fund in a public market, which means that if I'm investing uh, over the next 5 years, I'll have to, whenever I invest into VC fund, similar kind of investment amount, I will invest into public market. And whenever exit happens and VC funds returns the capital to me, similarly, I'll exit from public market. This will be the right apple to apple comparison to compare the performance of VC fund vis-a-vis public market. And that's why if you look at the over the period of 8 to 10 years, the VC funds generate a much more higher return compared to a public market. So, like I take an example of this is the first fund launched by Bloom in 2005. If we look at the performance, over the period of I think no, it was launched in 2012. So over the period of 10 years, it generated IRR of a 21%. If I compare a public market, right, it has generated around 13 to 14% return. So which means that the VC fund has generated more than 7 to 8% IRR over the public market. A similar thing, if we have to compare the performance of various VC fund vis-a-vis public fund, we'll have to first understand the vintage of that particular fund. Vintage is something like the fund or start of the fund when the fund was started. So if I look at the vintage FY14, which means that the all the funds which have started operations in FY14 are considered for the calculation of the IRR. And if we look at their performance over the last decade, the highest return generated by them was in FY22 when the IRR was almost 21%. And if I look at the various vintages, whether it's a fund started in FY14, fund started in FY15, 16, or various other years, FY22 was the peak of their returns, and after that, return has come down. I would say that by maybe a marginally. One reason could be a drop in their valuation. That's a major reason because of which the performance has come down. But over the period, if I look at their performance, are still in higher double digits, closer to 18 to 20%. So these are the kind of returns of various vintages of AI generated over the last decade. But now let's compare it with a public market like Nifty or any other index fund to understand the kind of alpha generated by these AI over a public market. And if I look at the alpha vis-a-vis various vintages, on an average, these funds have generated alpha of 8 to 10% of different vintages. And these are the various number of schemes involved in calculation of that particular AI. So for an example, if I look at March 23, the I would say that all AIF schemes or 268 AIF schemes have generated together IRR of 22.5%. Vis-a-vis the S&P BSE has generated a return of 12.5% or 12.3%. That's why this kind of AIF have generated more than 10% alpha. But what is more crucial for generating this kind of alpha for AIF is to maximize return by getting out of their investments at a right time. And if I look at the IPO of a Zomato, Swiggy, or Nika and other startups which recently got listed on main board of NSE or BSE, these are the kind of returns are a output of this kind of exit. Now, next important factor would be, now that we have identified that AIF do generate a higher return over a public market and offer a reduced risk, how to select the right AIF for you. If I to select the right AI for each of you, these are the three benefits will decide which is the right AI. So first of all, HNI or ultra HNI have to understand what it needs. Whether does it want to generate a higher return, that's a alpha. Does it want to generate a regular source of income or capital, or the main objective is to diversify. So based on the right need, you can select the right alternatives to be a part of a portfolio. Of course, you can always go for a combination of. So if my objective is to generate higher return, I can go for a combination of portfolio of private equity, hedge fund, or a distressed private credit. If my objective is to generate higher return, I can create a portfolio of a real estate or private credit or maybe another asset class which can offer me a regular source of income. So the first step would be to identify the need of that investor, and then based on that need we can select the right AI to suit that requirement. So now let's take an example. So now my objective is to reduce the volatility. So generally, if I look at the traditional portfolio, the volatility is caused by the equity returns. So if my objective is to reduce the volatility, a part of that equity asset allocation can be attributed or can be shifted towards alternative investment without touching the allocation to fixed income. If my objective is to generate both higher portfolio return, then I would say that I can divest both equity as well as fixed income and move that capital toward alternative investment. Wherein, if my objective is to generate higher portfolio yield, then I should not touch the allocation to equity capital or public market. I should divest my bond portfolio, and part of that capital should be allocated to alternative investment to increase my portfolio yield. So these are the different kind of strategies that can be adopted by HNI or ultra HNI if they want to increase their return or to reduce the risk or to generate more regular source of income. So this is the information about AIF and the various strategy. The information is already shared on my desk by which you can reach out to me if you have any queries. But if I have to answer your queries right now, we can just go through the question and answer, and maybe we can try to answer those. Okay, so one question is about what is a VC fund. Can you explain one more, please? Okay, so if I have to talk about VC fund is a pooled investment wherein pooled investment quite similar to mutual fund, wherein instead of raising that capital from a retail investor, I reach out to either institutional investors or HNI or ultra HNI who can contribute at least 1 crore towards my fund. I collect that capital, park that capital in a VC fund or called AIF, and then we start making an investment into various startup to generate more return or higher return. Okay, so another question is why we prefer AI. So if I look at why AIF, so AIF is the only legitimate investment vehicle in India through which a person can invest into startup. So if someone wants an exposure to startup ecosystem, AIF would be the only investment vehicle that a person can invest into to take an exposure to startup ecosystem in India. Okay, so now next question that we have: how a retail investor invest in AI? So unfortunately, right now, considering the risk involved into this AI industry and the kind of risk appetite of a retail investor, uh, right now, individual retail investor cannot invest into AIF. A big HNI who can at least contribute a 1 CR towards this AIF can invest into AI. So minimum ticket size for AIF is by default by the regulation is 1 CR. How much capital need, it depends on the fund to fund. So if I look at a micro VC capital or micro venture capital which makes a small VC bets or small startup investments of 1 to 2 cr, their initial capital could be 40 to 60 cr. Wherein if I look at another VC fund, their investment corpus would be 500 to 300. See, if I look at a lifestyle cycle, or sorry, if I look at the life cycle of a AI or of a startup, it starts from seed capital to a late stage private equity investment, which comprises seed money, Series A, Series B, Series C, and onward. So, depending upon the strategy of a AI, whether it is investing at a pre-series A level, seed or series A. The corpus requirement determined by the strategy of a investment manager. So someone who is targeting or investing into startup with a capital of a or with a investment ticket size of a 5 to 10 cr, probably their fund size would be not more than 200 to 300 cr, so that they'll allocate a 10 cr each into maybe 15 to 20 capital 15 to 20 startup. Similarly, if someone who is more focused on a series B or series C investment, wherein they would be writing a check or investing of 100 to 600 cr, their corpus or the fund size could be in $1 billion. So next question, does VC similar to angel investor? Yes, but as I said, the angel investors are the first investors which invest into companies which are early in their life or at a seed level, wherein they don't have any kind of revenue yet, and they are supporting these entrepreneurs. So that's a more of an angel investor. Wherein VC, they also contributes or invest into startups, but at a much more later stage, maybe at a seed level or series A or series B onwards. To become a next question, to become an AIF distributor, yes, to become an AIF distributor as per SEBI regulation, you have to pass NISM certification and become eligible to distribute this AIF portfolio or AIF schemes of various investment manager. Okay, so another person, he's a retail investor, not a HNI, but want to understand how he can enhance his return by taking a exposure to AIF or startup ecosystem. Unfortunately, the existing AIF regulation doesn't allow you. Of course, the objective is that because of the risk appetite of a retail investor, if they want to invest into startup ecosystem, maybe you should identify a mutual fund which do invest into startup ecosystem or take a exposure to such kind of startups. That would be the right way to take a exposure to startup ecosystem. Next question is, what is hedge fund? So hedge fund is a kind of fund which does not invest into VC or startups. They invest into public market, wherein they take a contradictory position and earn a higher return. So take an example of, okay, maybe because of various reason, I believe that, okay, Tata Motors are likely to perform better because of the new launch that they are coming up, the demand for their e-vehicles and other reason. I believe that over the next 5 years or 2 years, Tata Motors is likely to generate a higher profit or higher return compared to compared to Suzuki. Though Suzuki have a 50% market share in domestic passenger vehicles, it doesn't have a large portfolio of an electric vehicle. So I believe that, okay, Tata Motors could be a good long opportunity, and the risk and the I would say that, that market share will get diverted from Suzuki or Maruti to Tata Motors. So hence I'm a long on Tata Motors, and I'm short on Maruti Suzuki. By way of doing this kind of strategy, I generate a higher return. So these are the kind of various strategy adopted by hedge funds. Okay, what is the difference between a small cap companies and alternative investment? If I look at a small cap company though are in a small size or in terms of market cap, they are already listed on stock market, whether it's a BSE or NSE. So investing into them and exiting is much easier. They offer some kind of liquidity for a retail investor through stock exchange. If I look at alternative investments, no, such kind of exit possibility does not exist for investment into AI or alternative investment. So in terms of liquidity for AIF investment does not exist. That's why, from a retail investor point of view, they can still take a exposure to small cap companies through either small cap fund or through direct equity, but taking exposure to AIF is not allowed by SEBI regulation. Okay, so another interesting question is that, okay, how do you compare a different kind of AIF industry which exists in India vis-a-vis US and other capital markets like a China? So if I look at a China as a capital market or as a startup ecosystem, of course, there is not too much of information available about a startup ecosystem. See, we have to understand that it's a communist country. They don't have a entrepreneurial startup ecosystem which is as developed as a US, right? So they don't have a VC capital which exists, right? At least not that I am aware of, which are actively invested into Chinese startup ecosystem. If I look at a US ecosystem, startup ecosystem, it is a much more bigger and developed. Vis-a-vis, if I compare AF industry in India, we are just, I would say that emerging. We are yet to catch up a lot. See, first of all, we have to understand why startup ecosystem is important, because we have a young population. When we say we have a dividend demographic, right? We have a young population which are looking for generation of employment through entrepreneurial spirit. Then of course the objective is to create a wealth for themselves and the society as well, and by way of a startup they are carrying out innovation, generating new business model, and serving their customers in a better way. But still, if I compare it with the US startup ecosystem, we are yet to reach there. We are far away from there yet. Another question is regarding, is it a better to directly invest into startups or VC fund? Yes, I would say that it's always better to directly invest into AI rather than investing directly into startup. There are a couple of reasons. If I look at a AI, there is a one investment manager, just like a mutual fund manager, who has got a special expertise to understand or to judge the potential of that startup, to help the startup in growing from 1 to 10 and then 10 to become a unicorn. See, that's a kind of special, I would say, skill set a person or investment manager is need to have. That skill set is possessed by the investment manager. Third, AIF offers you a complete portfolio of a 20 to 30 good investments. Okay. If you start invoking angel investment, not necessarily you can create such a good, well diversified portfolio that can give you a higher return. You may be investing into startup, but you cannot, as a investor, angel investor, not necessarily that you can help the startup in growing in multiple to generate that kind of return. That's why it's always better to take a help of a specialized person or expertise person like a AIF investor or investment manager. Another question that I have: what is PIPE? So PIPE is an abbreviation of a private investment in public equity. So suppose I have a AIF, but I'm not investing into a startup which is an unlisted equity, but I'm investing into public market. So that's called private PIPE deals, which is a private investment in public equities. Where are AIF traded? AIFs are not generally or necessarily required to be listed on AIF or listed on NSE or BAC. Understand that average ticket size is 1 CR if you have to make an investment into VC. Second thing, it's a close-ended fund wherein your average tenure of a fund is 8 to 10 year, which means that if you have invested 1 CR for another 8 years or to 10 years, right, you're not likely to get your capital back. That's why this kind of products are majorly suited for HNI or ultra HNI, which has got a higher risk appetite, higher risk capital, and they can generate higher return based on that risk. Okay. Now, which AIF to choose for? See, it depends. As I said, it depends on a person to person, HNI to HNI, depending upon its risk, depending upon its objective, and depending upon its existing public and bond portfolio. Whether does it want to generate a higher return, does it want to generate a regular return, or whether HNI is looking for diversification of its portfolio. So depending upon that, right AI portfolio or alternative portfolio can be created for that HNI. Now, what is the taxation and GST for investor and for distributor? So, if I look at a taxation point of view, the category one AIF are a pass-through vehicle, which means that funds doesn't get taxed, and all HNI or ultra HNI that receive a capital will be taxed in their own hands, as if it's the income generated by them. Similarly, if I look at a CAT 3 AIF, CAT 3 AIF, which is a hedge fund, are taxed at a fund level. So, depending upon income, whether it's a business income, dividend income, or interest income, they will be taxed in the hands of a fund manager. And if that income is getting taxed at a fund level, the return generated by investor is a tax free. GST for investor, again, it's a debatable. Right now, there is no clarity, of course, whether the income generated by investment manager is subject to GST or not, and if that GST has to be charged on the management fees or the complete investment contributed by the investor. There is still not a clarity, and that's a debatable topic when it comes to GST on a contribution. Okay, so as I said earlier, unfortunately, a retail investor cannot invest into AIF, as the minimum investment contribution investor needs to contribute to AIF is a 1 CR. So it's a kind of high risk product created majorly for HNI or ultra HNI, who can have that kind of risk appetite. Okay, what is the benefit for retail investor if we can't invest on AI? Of course, right now they don't have a benefit, but they don't have any kind of risk as well. See, if I look at a retail investor, they don't have higher net income, they don't have a higher capital base, and they don't have a higher risk appetite, right? That's why this product as a AI, right, is not suitable for a retail investor. It's more suitable for investor who has got a substantial income, and he can take a exposure by investing into this kind of AI. Okay, can we invest in AIF through mutual fund? No, there is no mutual fund which invest into AIF as of today. What is the lock-in period? As I said, this AIF are a close-ended investment product, wherein if you give a commitment today over the investment horizon of 7 to 8 years, you cannot redeem or you cannot withdraw your money. You will get your capital back once those investments start paying off, or investment manager start exiting from those investments. Then only they will start repaying your capital back. Thank you, guys. I think I have answered most of the relevant question of all the investors, or rather of all the individuals.
Thank you so much,
Rajalakshmi,
sir.
over to you.
Yes, sir. Thank you so much, sir, for delivering such an insightful and engaging webinar and patiently taking up so many queries from our participants. And of course, a heartfelt thank you to all the participants for joining us here today. And we hope you found the session informative and you gained a lot of valuable insights. So we look forward to see you in all in the next webinar. Till then, have a very good weekend and a very good evening. Thank you all. Thank you so much, sir.
Thank you, everyone. Thank you.